Welcome back to the weekly market recap for the week ending September 20th, 2024. We're going to talk about what happened this week in markets. Before we do, hit the like button, subscribe to the channel. You can also find me on Twitter at Mr. J. Thomason. Sorry, that wasn't ready. You can also follow my weekly newsletter at befinanciallyfree.substack.com. The links to both of those are in the description of the video below. So Fed cut 50 basis points. That's kind of the big news this week. I think there were some people who thought that, at the beginning of the week, the betting markets were saying, and the CME futures were suggesting it was literally a 50-50 chance of either 25 or 50. I think we had a strong retail sales number early in the week that made people think that we might go to 25. There was a point where we were way more leaning towards 50, and then it kind of dialed back. I just say watch the 3-month yield. I could just pull it up for a second. I have these. I have this. These bars. I had these bars that I basically put here. Like a month ago or 2 months ago, just watching, and that's all I do is I just watch the 3-month because that leads, and so it's direction and level. If you can understand both of those things with the 3-month, you can figure out what the Fed's doing with rates. Does it even matter? When rates were high, the markets were going up, and now that the Fed cut, markets are going up. There's a lot made about if the Fed was going to cut rates, that it was going to cause markets to drop. There was a really interesting day on Wednesday where the S&P, the NASDAQ, like basically all the equity markets on the announcement and at the beginning of the press conference, the market boomed. In fact, if you go to a 5-minute chart and you go to what the markets did that day, is actually really crazy. We had S&P like a percentage point move up and down and up and down and up and down, and then of course you could see the massive gap up, and that's what we had. Sorry, I just messed up here. And that was, we had this giant gap. The price action on Wednesday was pretty wild with the FOMC, but what was even more wild to me is the gap that we had between the close, the 4 p.m. close on Wednesday, and the 9:30 a.m. open the next day, yesterday. Just a ginormous gap. Most of the price action that day, most of the move happened when markets were closed. So unless you were trading futures or doing pre-market, post-market, then you missed out on most of that gain, and that tends to happen a lot of times. So I thought it was interesting because the price action at the end of Wednesday suggested that you should be flat, and my systems actually, at least one of my systems got me flat. So it kind of sucks to miss that boom, but what can you do? That's what happens when you do things systematically. You're going to miss things, but the good thing is the market's always going to be there, so that's okay. But in any case, what's interesting is you had that reversal in the close red despite the boom on that news, and then it was actually Thursday yesterday where the big move in price action happened. And I point that out because I talked about this in my newsletter last week, that whenever the Fed has cut 50 from the peak, which basically you go back and you look at 2007 and 2001, which were both occasions where the Fed cut and the first cut was a 50. And in the case of 2001, it was a surprise. They did it inter-meeting. And in the case of 2007, it was a normal Fed meeting, but they cut 50. And in both of those cases, the market was up more than 3% on the day. And so I would have expected, going into the Fed meeting, I would have expected market to be up, maybe not have to be 3%, but to be up pretty high that day. And it looked like it was going to do that, but then it closed down. So kind of throws everybody off to make the price action go that way. And so here we are, we're at new all-time weekly highs on the close this week. And, frankly, it doesn't look like there's any reason for markets to go down anytime soon. We've got a lot of mixed data. We could look at a couple of things. It kind of looks interesting because the dollar had one of those reversals too. You would think on a 50 basis point cut that the the dollar would sell off, and it did, but it came back, and then it ended up going up yesterday. We had some good jobless claims data come in, some that showed more strength in the labor market. Dollar was up and then closed down, so that was weird. And then we were a little bit up today, but we had a lot of volatility in the dollar today. There was a BOJ meeting that ended during the overnight session, so that has probably a lot to do with the volatility there. I think we had some economic data in the UK that affected that as well. So really interesting there. Dollar is kind of sideways here, so it's not really clear. If dollar goes down, it's going to be net positive for equities going forward. But what's really interesting to me is that the consensus is that once the Fed starts cutting rates, the dollar goes down. But if you think about it, I mean, we've been anticipating rate cuts in September for some time. So I'm wondering personally if the dollar is going to have a counter rally to the upside. The question is, can the dollar go up and equities go up? And so that's something we have to consider. The yields, interestingly, on rate cuts were up. And again, I think that's something very similar. I think people assumed, and markets have been pricing in, that Fed rate cuts were going to, that rate cuts were going to be good for bonds. And we actually, let me see if I can find it really quick. If I go to my futures charts and I pull up the 30-year, then we not only closed down, but if you go to the weekly chart, we had a weekly outside reversal candle in the long bond. And I didn't actually look. I'm going to check right now to see if I can find my TLT chart. Same thing, TLT outside reversal on the week. And so to me, I'm wondering, again, just like with the dollar, did we pre-price in, did we front run the rate cut? And now are we going to have, I'm not saying that we're going to go, up and make new highs or whatever, but did we, actually that's pretty crazy. Look we're still in the sideways range. We're at the lower end of this sideways, maybe you call it a channel. Are we due for a move up towards the upper part of that channel? And then same thing on the yields. We are at a new yearly low in the yields, or we did make new yearly lows. We're not lower than we were a while ago, back in 2023. But are we going to get a counter rally? Or is the yield going to go up? And if the yield goes up and the dollar is going up, can equities stay up? So that's another thing we have to factor, right? So we've seen a pretty good steepening in the 10s 2s curve. The 10-year 3-month curve has moved 40 basis points or more in the last 2 weeks. So that's a big deal to me, because one of the things I would say is, as we're trying to think about what's happening, the 10-year 3-month is perfect at predicting recessions by being inverted. Most people watch the 10s 2s, but the 10-year 3-month is the one that is actually undefeated when it comes to predicting recessions. And the thing here that I've been talking about for some time is if this thing disinverts, and if it disinverts strongly, so like right here, you can see this going into the 2020 crash and recession there. If you go back to the 2008 financial crisis, you can actually see it, the steepening really happen. You can, and this is the part that I want to get at here is, in 2007, it disinverted, came back down, reinverted in August of 07, and then it shot up like a rocket, and then, obviously stayed uninverted after that. And then when the NBER in 2008, I think it was in December of 2008, they backdated the recession to December 2007. So technically that was 2 months, or not two, that was a few months ahead of the August disinversion. That rocket to the upside was just a few months in advance of that. So that's one of the things that I'm watching for. If we continue to get a really steep disinversion, like a steepening, and then it disinverts, that's to me going to be a warning sign, and I'm going to start looking for, you know, some recessionary price action. So I just wanted to point that out. So that's another thing to be concerned about. Gold is booming. Gold's at all-time highs, over 2,600, and that's to be expected considering the you know, the Fed rate cut. But what was interesting is we got the reversal in gold, but price made a new all-time high, so that's interesting. And then it's also interesting because crude oil dumped and it's been up since. So I just feel like there's a lot of really interesting cross currents. Equity breadth is still pretty good, generally across the board. So there's a lot of questions. So my view of this is you don't short at all-time highs. I mean, eventually every all-time high does reverse, and then there's a correction or a bear market or something like that. But it's generally not a safe practice to be shorting all-time highs. So the question is, what's the likelihood that this continues? I mean, I think, like I said, if there is upside price action in the dollar and if the yield goes up, then I think it's going to be not impossible, but harder to see like really strong moves in equities to the upside. Alternatively, you know, I have some positioning charts. I wanted to point this out. On the VIX futures, now granted, the VIX futures on the COT data, like all the COT data is updated as of Tuesday. Now that's the day before the Fed meeting. And what this suggests to me is if you actually look, the red bars indicate large speculators. The large speculators, which are usually the ones, well, the speculators you usually want to fade, they are as long volatility as they have been in years. So my suspicion is that everyone bought vol in preparation for potentially a market dump. So the problem is and there's a lot of dynamics. You can go watch like spot gamma videos or options insight videos, or go watch Jim Carson from Kai Volatility. You can watch or listen to some of the things that they're all in, and they'll tell you about how the vol structure, like in the VIX and all that, how that can affect the markets to the upside or to the downside. And in this case, my thing is, if these positions are unwinding, it's going to crush the VIX. That's going to produce, I think, Vana and Charm. I think that's what it's called. That's going to provide fuel for the markets to the upside. Now, the caveat to that is that this was also a VIX expiration week, and in terms of the options, I should say, and this is a triple witching options expiration for equities and basically all the other options as well. So there's a caveat to that too. But my thing is that this could provide some further fuel to the upside. The other thing is on the S&P, if you pull up the positioning data from the COT, you can see that the red bar, it's not the lowest it's been, but it surged to the downside. So the larger speculators got way more short ahead of the FOMC, which to me somewhat explains some of the price action that was going on on Wednesday and possibly even on Thursday. So I guess on net, I would just say that it's possible to see equities continue to grind a little to the upside. There's other stuff that could be contradictory too, like the AAII sentiment survey has surged more bullish more recently. Long-term ETF fund flows data shows that people have been selling equity funds in the month of September, like pretty strongly. So that would be that's kind of similar to this positioning data, which to me suggests that there could be some fuel for buying over the next week or two. So it's really interesting because you would think that the FOMC rate cut would provide clarity, but now there's other dynamics not related to the Fed that are clouding the waters here a little bit. What else is interesting too, and I had this positioning data pulled up, was the yen. Let me go to the yen chart. I have to go to the futures. Here we go. So if you look at what happened on the yen, again, this is related to the dollar price action from Wednesday. You would think that a rate cut when the Japanese have raised their interest rates more recently and have talked about having to continue to tighten their policy with inflation concerns and things like that, and wage concerns, you would think that those things net would be, strong move up Japanese yen, and it did, but then it retraced that entire move. I mean, this like over a 1% move to the upside, retraced it to the bottom, didn't close red, didn't close down technically, but it gave it all back. And the reason why that's significant is a lot of people have been talking about how, pressure from, the reverse carry trade. Well, that was the case for a couple of weeks, but then markets are like S&P's back at all-time highs. And the yen is higher than where it was. It's almost as high as where it was on the spike when the VIX went to like 80 or 60 or whatever that was. So it can't just be about the reverse carry trade, but a lot of people have been wondering about that. And the positioning data, I've been pointing this out on my newsletter. The yen went from max short in this in terms of speculators to they are longer than they have been in multiple years. I mean, we have to go back probably more than 5 years, maybe 6, 7, 8 years to find another time where both the small and the large speculators were long, just even net long, let alone as long as they are now. And in my newsletter, I've been flagging it, but I've been saying, I don't know, because the other occasions where the yen went from being max short to being like speculators net long often were trend changes. And I'm not saying that the yen is going to go back down and make new lows. I'm not saying that the trend hasn't reversed. But I mean, if you actually if you actually look, there's enough here. Like the yen could come way down and then just make a higher low and then go back up. I mean, there's a lot that can happen in this area. Like, so just because I'm saying, like this candle, like this is a failure. This is a market failure, or what do they call that? A news failure. This is a market confirmation. So, like the yen is relatively max long in terms of speculators. It failed on a day it should have been up. This is a short. This is a short. This is a big time short. And actually, let's see. Yeah, it's a short. And if you actually go to the yen ETF FXY outside reversal, okay, this is a short. It doesn't mean that it's going to go down and make new lows, like I said, but this is going to go down for a while. I could see the yen going down for 2 or 3 weeks. It doesn't have to crash. It can just grind its way down as those positions, as some of that positioning gets unwound. So that's just my opinion. And then that's another thing I wanted to mention is if the yen does indeed get sold, it could, I'm not saying it will, it could induce kind of a reignition of some more of that carry trade. Maybe people are going to think, oh, it's over, like the unwind is over, we can get back into it, because it was really profitable for people. And the concern there is that if it sells off, that people might feel comfortable getting back in it, trying to pick up pennies in front of a steamroller. And then that could actually be more fuel for equities to go higher. And then what if that unwinds again? So anyway, these are just some things I'm thinking about, but you can't, like my thoughts and what I actually do are not the same, because I have to be you have to be systematic. You could be wrong, I could be totally wrong about this, but as long as my system has me doing the right things, and if I'm managing my risk properly, then it doesn't matter. As long as I make money, that's all that anybody should care about. So, but that's just kind of my look on things. Obviously, I got to do a little bit more looking, but this is kind of my view at the end of the week here on a fresh glance. So, with that, I'll stop there. Subscribe to the newsletter if you want to get some more insight. That comes out Sunday morning at 10 a.m. at 11 a.m. Eastern time. So, with that, let you guys go. Hope you guys have a great weekend. I'll see you guys next time.